Mortgage rates moved just enough this week to make buying harder again. On a 700,000 loan, that means about $60 more per month and roughly $9,000 less in buying power. This week felt like mixed signals everywhere. So if you're wondering why aren't mortgage rates clearly improving, you're not alone. Not every headline moves mortgage rates equally. Rates have moved higher from last week. Here are the three rate triggers and what it means for you. Number one, stronger labor data. This puts pressure on rates. This week's job data, including ADP and continued low jobless claims, came in stronger than expected. A strong labor market keeps inflation pressure alive. If the economy is still strong, the Fed is less likely to cut rates soon, and that can keep mortgage rates higher. Number two, inflation is still not cooling fast enough. So markets still believe rates could stay higher for longer. That means affordability is still tight for buyers, and many homeowners waiting to refinance are still stuck. Number three, oil prices ease slightly after geopolitical tensions show signs of cooling. This helped the market settle down for a bit in the middle of the week. Lower oil prices eased some inflation pressure, which gave mortgage rates a little relief. But that relief did not last as stronger economic data pushes rates high again. Weekly mortgage trend as of today, the 30-year fix, according to Bankrate, is 6.78%. Last Thursday, we were closer to the mid 6.6 range. So week over week, rates move slightly higher. For buyers this week, this is one thing. Real rate relief is still not here. Strategy matters more than timing. Seller credits matter. Rate buy downs matter. Negotiation is still possible in many pockets. Waiting for lower rates is still a gamble because if rates improve later, competition could pick up fast. For sellers, rates holding at these current level means buyer demand stays cautious, but they're active. You're still getting buyers. They're just more payment sensitive and more likely to negotiate. This is not a peak frenzy market. It is a pricing and strategy market. Homes that are positioned correctly are still moving. Overpriced homes are sitting. Buy to sell and move up view strategy is really matters. If you're selling and buying, your equity is still strong. Inventory is slowly improving, but your next payment will more than likely be higher. That's where structuring comes in. Lease backs to buy, recast to lower future payments, and seller credits to offset rates. This is not a wait market. It is a plan it correctly market. Is the market balancing? Yes, but slowly. We are seeing some early signs of normalization. A little more inventory, longer days on the market in certain segments, and more seller concern. That does not mean the market is crashing. It means it's starting to normalize. This creates opportunities for buyers and sellers who adjust their strategy. There are also a few policy changes that may help at the margins. Basel could make mortgage lending a little cheaper for banks over time, and the new Fannie and Freddie insurance changes may reduce ownership costs and make some loans easier to qualify for. Neither one is a direct rate cut. Mortgage rates are still driven by mainly inflation, bond markets, and the broader economy. Weekend advice: if you're active right now, don't shop based on price alone. Shop based on payment strategy. Run your numbers at today's rate. Then look at how the credits or buy downs can change that. That is where deals are being won. Before you make a move this weekend, Look at your real payment, look at your real options, and your real strategy. In this market, the structure of the deal matters more than rate headlines.